Well, let's move on from this topic and enter a very important subject where we want to explain the value and robustness of technical analysis to you, dear ones. That is, beyond the basic principles and concepts of technical analysis, there is a very, very important question that I refer to as the first principle of technical analysis. My question is, a company, or rather let's say a stock that you have in mind, in the stock market, for example, the shares of the National Iranian Copper Industries Company, the shares of the Family National Iranian Copper Industries Company, or the shares of Iran Khodro Company, or let's assume the shares of Mubarak Steel Company. What events happen to this stock in the market? You can see this in the slide. This stock might actually have an EPS adjustment. Let me explain EPS adjustment right here for those dear ones who are new to the capital market and are not yet familiar with these terms. You see, companies, depending on the type of their activities, provide a series of management reports in the market. For example, as the financial manager of a company, I must present a management report to the board of directors in the current year we are in. Based on what events will happen to us this year, and considering the changes we have had in, for example, our production line, how much profitability are we expected to have? This is the report that I provide as a forecast. This is my EPS forecast report, or earnings per share. EPS stands for earnings per share. Companies make every effort to achieve the appropriate EPS they have in mind. Well, I specify an EPS and present this report. 2 months of the year have passed. Suddenly I realize that the report I gave 2 months ago is now outdated because, for example, a part of our production line has encountered a problem and we can't achieve the profit we had forecasted for this year. This is where, as a publicly traded company, I am obligated to disclose this information. This means I must disclose this information to the investors in the capital market so that they become aware. I analyze and see the profit I had in mind. I can no longer achieve that profit now. I quickly post this report on a network called the Caudal network, which we will explain more about, and we will become more familiar with this network in the courses on market board reading and filter writing. I quickly upload this report on the Caudal network. I mean, for example, I could generate 60 reals, EPS per share. Now, due to a problem that has arisen in the company, part of our production line is, for instance, down. We can generate 45 reals of profit. Well, the profit has also decreased. When I present this report, they say that the company has had a negative adjustment. A negative adjustment. In a company's EPS is bad news for that company, which can decrease the value of its shares. And vice versa, I might need to provide a new report 2 or 3 months after the company's activities. I realize that we have created a good condition in our production line. The capacity of our machines has increased, or anything that allows the company to generate more EPS compared to the previous estimated EPS. I previously predicted that I could generate an EPS of 60 rials. Now I can generate 75 rials. Well, quickly, as the company's financial manager, I present this report on Caudal, indicating that our company, given the good conditions and these calculations, can generate 75 reals of EPS instead of 60 rials. The team refers to this report as an EPS adjustment, positive EPS and yes, or positive EPS adjustment. The positive EPS adjustment leads to an increase in the stock price in the market, the same market appetite we talked about earlier. When a stock shows a positive adjustment, the market's appetite for the stock increases. So these are the reports related to EPS adjustments, which can be positive or negative. The next factor is capital increase. Companies, depending on their activities at the end of the year, the profit they generate, but this profit can actually be divided. This profit that is generated, which we call EPS, is divided into 2 categories. EPS is divided into 2 categories. The 2 categories that are DPS and retained earnings. DPS, or dividend per share, is the dividend per share. What does that mean? It means, for example, I came and saw that at the end of the year I can generate a profit of 60 rials per share. This is the profit that I generate. So what is this profit? This profit is essentially a reward for the shareholders who have held onto the share for a year, and now it should be allocated to them. However, companies do not always distribute all of this profit among their shareholders. They keep a portion of it, and where do they take it? Guys, they take it into retained earnings. So, for example, if you have actually made a profit of 60 rials, meaning you have an EPS of 60 rials, we might distribute 90% of the 60 rials as DPS and 10% as retained earnings. And this percentage that I mentioned to you, dear ones, is called the dividend policy. For example, they say, Kerman Motor Company's dividend policy is 90-10, or its dividend policy is 90%. What does this mean? It means that whatever EPS it generates, it gives 90% of it as DPS to the shareholders and takes 10% into its retained earnings. Now see why I mentioned this topic to you in the context of yet capital increase. Any amount of profit that remains in the form of retained earnings in companies, as the name suggests, is retained profit. This retained profit accumulates, and when it reaches a certain amount, companies can use it to increase their capital. It's very important. People say a certain company's capital was, for example, a certain amount, and now it wants to increase its capital by 100%, meaning doubling its capital. This capital increase is through that retained profit. Now, the profit from capital increase has different methods. We have capital increase through cash contributions. We have capital increase through retained earnings, and each of these methods includes capital increase through revaluation surplus of companies. In fact, there are 3 general methods of capital increase in the capital market. For different companies, including those not in the capital market, but for companies whose capital increase is through retained earnings, and this capital increase amount comes from the same retained earnings I described to you. In fact, it is taken from there. It might include not only an increase in the capital of the contract, but also sales and purchases, managerial changes, fluctuations in the price of raw materials or currency, political factors affecting the market. Let's return to my question. What is a comprehensive reflection of the market? That is, what are the important news and rumors in the market that can affect the capital increase, contract sales and purchases, managerial changes, price growth or reduction, political factors, and many other factors? What can be a comprehensive reflection of these events in the market? If you think about it, you'll realize that the answer to this question is summed up in the term price. Price is the comprehensive reflection of the market, meaning any event that happens to a stock ultimately changes one thing: the stock's price. Why did I mention this to you? In many past technical trading courses, and in this course that I'm recording, I've conducted over 250 technical trading courses. In these courses, it was often asked whether, if we learn this course, there are many other events that affect the stock price. For example, suddenly the US stock market crashes, affecting the Iranian stock market. Or the president of a certain country makes a statement and our market drops sharply. We can't predict these things, right? Don't make the mistake of thinking that. No, don't make the mistake of thinking that at all. All events, whether political factors, events caused by the company, or unforeseen circumstances, any event that causes a change in the stock affects the price. And keep this point in mind. In the science of technical analysis, whenever we examine the price chart of a stock and use analytical methods, we are analyzing the stock's price. The chart you see of the stock and are working on, what is it, guys? It's the stock's price chart. The stock's price chart means each geometric connection of points resulting from the stock's price has been drawn and turned into a price chart. When you are analyzing the price chart, it means you are analyzing all these factors on the stock. So when doing technical analysis, don't worry about the fact that you are analyzing the stock right now. Many unrelated events might occur that you are not aware of and might not analyze. No, don't fall into this mistake. So we say the price is a complete reflection of the market. The price is a complete reflection of all the factors affecting the market. If we analyze the price correctly, we can correctly assess the impact of all influencing factors. Now, there is a very interesting point that we want to draw a conclusion from this first question that I asked you. We say that all factors are reflected in the price of a toxin, and the toxin price chart is a complete mirror of the factors responsible for the toxin price. Or as the books say, in fact, if you read the original book, they say exactly the price or the average of price discount, everything. The price shows everything. Guys, it might be interesting to know that the sentence I just read to you is the first principle of technical analysis in the capital market. In the capital market, there are three very important principles that we need to know. One point, a request I have before I talk to you about the second principle of technical analysis is that as a technical analyst, after you complete this training course and want to start analyzing and charting the price of a stock, always remember, guys, to review these three methods of analysis in your mind before analyzing any stock chart. That is, say to yourself, I want to examine this company's stock. Well, what was the first principle of the techniques? What was the second principle? What was the third principle? 3.5 principles that you review in your mind for 1.5 minutes, then go ahead and perform the analysis. Never analyze without reviewing the 3.5 principles of technical analysis. And this is very important. Okay, let's move on to the second principle of technical analysis. Okay, guys, the second principle of technical analysis largely goes back to Mr. Charles Dow himself. He initially discovered that the market has 3 trend lessons, which I personally amend. We can say that a stock's price chart has a trend or a movement when it is. In fact, this trend is either upward or downward. Look at neutral. I brought it down in this slide because neutral is not always a trend. We either have an ascending trend or a descending trend. Either we have an upward trend or a downward trend. We don't say neutral trend. There is no such thing as a neutral trend. We have a neutral state, a neutral space, a neutral state that exists, and you cannot refer to it as a trend. So with Mr. Charles Dow's permission, I make a small change to his statement. We can say that the market generally has 3 states or characteristics: upward trend, downward trend, and neutral state. Always keep these 3 characteristics of the market from the market's price chart in mind, guys. But the more important point that Mr. Dow correctly points out is that these trends have a strong tendency. Pay attention to this term. I'm reading directly from the slide. These trends have a strong tendency to continue moving in their current direction. Like Newton's law is a very, very important set of rules that we always use in our lives. Newton says that an object, when you push it, likes to keep going and always wants to continue on its path. It never changes its behavior until we change its direction by applying a force that alters its course. Mr. Charles Dow also says that when a stock's price chart has a trend, for example, an upward trend, it always wants to continue in its current state. It never likes to change direction. A trend changes direction due to specific conditions or obstacles that arise in its path. So, trends have a strong tendency to continue their current movement and will do so until definite signs of reversal appear in the market. This principle is the second principle of technical analysis. But guys, the question that arises here is, well, a trend that continues its movement until definite signs of reversal appear continues its trend. Now, what are those definite signs of reversal? The third principle of technical analysis shows you these signs. I mentioned in this slide that the phenomenon of the second principle of technical analysis has a great similarity to Newton's second law. We call it the law of inertia, where objects have a strong tendency to maintain their current state, and the market is the same. As long as definite signs of reversal have not appeared, the market likes to continue its trend. If it is bearish, it likes to remain bearish. If it is bullish, it likes to remain bullish. But let's see what the third principle of technical analysis is. Well, before we examine the third principle of technical analysis together, I made a conclusion here from the second principle. We said we have an upward trend, a downward trend, and a neutral state. A trend continues to be in effect until such time as its reversal has been definitely signaled. This is very important. Those reversal signs are very important. Those reversal signs are what cause the whole price chart of a stock to change its trend. Well, let's see what these definite signs are. Guys, the third principle of technical analysis is summarized in this sentence. History repeats itself, or as we say, homo economicus, human. This means human behaviors have a strong tendency to repeat themselves constantly, even if these behaviors might be incorrect. Sometimes you notice you have a behavior, you've gotten used to it, and you keep repeating it. You know the behavior is wrong, but you repeat it again and become upset and disappointed by doing that wrong behavior. These are the behaviors of investors in the markets. I need to tell you a very important point, and that is, guys, it's our behaviors in the market that determine the stock price. Sometimes we might make decisions impulsively. Sometimes with the buying and selling of a stock, we might also decide to buy or sell. And this very factor causes the stock price to decrease or increase. A very important point is that in some English books, these behaviors are referred to as sheep market or sheep behavior. This might not be a very good Persian term, but it's called herd behavior. Herd behavior in humans causes, because if you pay attention to sheep, they are the same way. When they see two sheep going in one direction, suddenly 1,000 sheep rush in that direction. Now, we certainly do not intend to be disrespectful. This is actually a psychological factor in the market that we call sheep behavior, or herd behavior in the capital market. It's the same in the capital market. Sometimes a stock becomes desirable, and a few people go and buy it. Suddenly, a very intense queue is formed for the stock, and a stock that has a buying queue and is attractive to everyone might also be attractive to you and me. We might join the buying queue for that stock, hoping to get it, but we might not be able to obtain that stock for days. But the very important point is to learn how to behave in such situations, which we actually manage in our technical analysis course. All right, let's get into this principle. I have explained the third principle of technical analysis below, that human economic behaviors must be managed. These behaviors stem from two very, very important factors, kids. One is fear, the other is greed. I have talked a lot about these two phenomena, fear and greed, in most of my TV programs. Why? Because truly, if you want to be a good analyst, it is very, very important to adhere to these two principles. That means don't get scared too quickly and sell your shares because of a drop, and also don't be too greedy and keep holding on to your shares just because of significant increases, saying it will grow again. It will grow again. I'll keep it, right? In technical analysis, you learn that you should not have any particular bias towards a stock. That means you say, I will buy this stock at this point, and I am not afraid, and I will sell it at this point, and I am not greedy. That means you take the exact general profit you have in mind and have no bias about this stock being a very good one. I see many of my friends, even professional analysts are there. Unfortunately, they develop a bias towards a stock. They say this stock is so great. I have faith in this stock. I'm sure this stock will go up a lot. They keep holding on to the stock. They incur significant losses on the stock, yet they still don't sell it. And this bias towards the stock is a very important pitfall that you shouldn't have. You should buy the stock at a specific price and sell it at a specific price. Well, let's not stray from our topic. You should know that the third principle of technical analysis is that history repeats itself. Guys, these three principles that I mentioned to you are very, very important principles that you should always try to review. In your mind once, and based on these three principles, conduct your stock analysis. Well, I also brought you the conclusion of the third principle, which is that the uniformity of human economic reactions and the repetition of history will make it possible to predict price patterns. In fact, it is these very behaviors that create a series of patterns. They create a series of patterns. These patterns have a schematic representation, which we will learn later, and using this schematic representation, we can predict the next price of the stock. So always remember, the history repeats itself. Well, these three principles of technical analysis are so important, guys, that I brought them up once again. Let's review it together in this slide. We'll go over it together once more. If at any point in this video you feel the need to better understand these methods, in these 3 principles, you can pause the video, read these 3 principles thoroughly, and keep them in your mind completely. And they are so important that I am there emphasizing them this much. Always review these 3 principles in your mind before conducting stock analysis. 1. Everything is reflected in the price. The price discounts everything. The price is what shows everything. The price is the full mirror of the market. 2. The market has 3 characteristics. It has 3 different states: an upward trend, a downward trend, and a neutral state. And these trends continue their movement unless a force intervenes and something causes these trends to change. And third, the history repeats itself. History repeats itself. When history repeats itself, it means that human emotional behaviors are repeated. When human emotional behaviors are repeated, it means there are various patterns in the stock's price chart that we need to learn and be able to use them to analyze the stock. Well, Nish, the topics related to the principles of technical analysis have come to an end here. In the next video, we will be with you, dear ones, with the topic of trend formation psychology and its classification.